From the morning reading, stocks break three-day losing streak, rise modestly. Helped by energy stocks, JCP is upgraded. 8 of 9 sectors moved higher on Thursday. XLV, XLE, and XLI were the strongest sectors, while XLU was the weakest sector. Breadth strengthened as decliners led advancers 1.01 to 1. I think something by the author there may have been flipped, but with a 1.01 to 1, that's essentially even. That's the New York Stock Exchange. And then 1.15 to 1 on the NASDAQ, where advancers led decliners. Also, high-yield bond funds have been hit hard. The two most popular ETFs that track the category, HYG and JNK, have been dropping steadily for more than a month. Still, optimism toward the fund is only average, not extremely low, and they have not seen any huge discounts to their net asset value. Looking at other 1 month and 3 month lows over the past 6 years, almost all of them saw more extreme sentiment than we're seeing now. According to Lipper, investors yanked $13.5 billion from mutual funds this week. That's the fourth largest weekly outflow since at least 2006. It's notable, however, that there is seasonality with fund flows, and most of the large fund outflows occur in December. They also note that investors took $7.2 billion from taxable bond funds. This is the second largest outflow since at least 2002. The largest was during the credit crisis of October 2008. Generally, such large outflows could be considered a contrary indicator, i.e. a good sign for both stocks and bonds, but with the seasonal influence, that argument doesn't carry as much weight. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:07 a.m. Central Time, and I'm recording this in preparation for the market day of December the 11th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And we've had decided weakness in the overnight. It's my understanding it started with the European Open. The S&P futures are down almost 1% at about, right now they're right at 19.25 points. The Russell is down about 0.8%. The NASDAQ down at about 1%, and as the Dow also down about 1%. Crude oil down about 1.28%. Euro up about 0.25%. Bonds up about 0.5%, and gold down about 0.7%. In overseas action, mostly negative. China down about 0.6%. Hong Kong down over 1%. Japan up about 1%, Germany down about 1.75%, United Kingdom down 1.1%. In terms of macroeconomic reports for today in the U.S., we have core retail sales, PPI, and retail sales, and then during market hours you have the University of Michigan consumer sentiment. So kind of be aware of all that. In terms of current volatility, obviously volatility has been rising, and it's one of those kind of controlled rises thus far. While the short-term VIX is up over the bullish threshold of an 18, it's now at 20.42. Skew also has been elevated. IV percentiles are also elevated from where they have been in the last couple of weeks, but they've been slowly but surely climbing up, and the S&P's at a 30. The NASDAQ is at a 21, the Russell 23, and the Dow at a 32. We had no standard deviation moves put in by any of the markets yesterday, though today could very well be quite different given the large overnight move. In terms of the charts, some pretty ugly, choppy action here of late, and we continue to deteriorate. 2 days ago, we undercut this swing low, and it would seem that we're going to undercut that at this point. We'll probably end up opening, oh wow, we're going to be opening right at this swing low, the 2020 area it was seen. has not actually violated that 2020 area of yet. I'm guessing because obviously there's a point differential between the S&P futures and the SPX. We're going to be really close either way. So it's going to be very interesting to see when all the market participants come in at the cash open, do they rescue this? Do the bulls have the wherewithal to pick this thing up and take it up from this support area? If this support area breaks, that is much more ominous for the market. And I suppose we could draw some fib extensions and so forth and try to find some support. Might have some support here at the round number 2000, and then the undercut of that about the 1990 on the SPX. And after that, it gets to be pretty clean air, other than fib extensions perhaps, all the way down to the 1870 area. So this is definitely a must hold area for the bulls. In terms of the Russell, would seem that it's going to come into this key support here, which was the 38 fib extension. And again, after that area, it gets to be pretty clean air. You can see the fib extension here that was drawn from this action. We probably would need to draw a fib extension from this action here. But the bottom line is that we are breaking through some very, very important areas of support. NASDAQ has been relatively stronger, but also keeps kind of breaking down. And Dow, much like the S&P, would seem to be coming into this 172 on the DJX area. Let's take a look at the VIX futures. And you see with the overnight action, we have popped up over 20. So definitely not good. And bonds. Let's go ahead and go to the bond future since we've got so much activity overnight. Bond futures are up near their near range. You could see that they could be running into something of resistance. If bonds start to turn, you might see that the stock market starts to go up. That being said, in recent trading, the correlation, the inverse correlation between bonds and stocks does not seem to have been holding much of the time. So that we might see bonds going up and market going down, sure, that's kind of what you expect, but you could also see bonds drop and the market drop. So that correlation is not terribly powerful at this time. In terms of the daily report, we've had a number of important changes here. We are still phase 5, the break of horizontal and diagonal support, and that's even more true now. IBD status, uptrend under pressure, and I have to believe that we must be getting terribly close to market and correction. So just kind of keep that in mind. Accumulation distribution score for the S&P is a D-, the NASDAQ a D. Obviously can't get much worse than that. GMI index, this is a change to 1 out of 6 and issued a sell signal since yesterday. That author remains in cash. And you remember, that author never went in during the recent action. When that buy signal was issued in the middle of October, he remained largely in cash through all of this chop. And now this has rolled over into a sell signal. We'll continue to watch if this persists. These can be subject in bull markets to whiplash. So it's something to kind of keep in mind there. Bear market, neutral bear in the primary market condition. That's where we have a relationship of key moving averages and the way they're stacked. Decision point scoreboards. This also is an update, and you see the short term is very ugly in almost all cases. Intermediate term continues to hold up. Long term continues to be very, very mixed. If you put all this together, you've got a sea of red here, an awful lot of bearish signals against very, very few bullish signals. I would say that at this point, while we are still a market in transition and we've not totally broken down, we are definitely in increasingly elevated levels of risk. And indeed, The hedge risk level has been elevated to a level 2. That is a red light. And there's a couple things to think about when you are in level 2. First of all, and you might want to get a pencil, make a couple quick notes here, but you want to double check your alerts for key support areas that would trigger additional hedging actions. You want to double check all your stops and whether they're hard stops or alert stops to trigger a judgment call by you. Have your thoughts collected as to what decisions and strategies you might want to invoke. You got to be prepared. When it's in the heat of the moment, it's often very difficult to make decisions as things start escalating. And not saying that we're going to do that today, but you have to be prepared. And this is the time when you do these checks of your positions. When you first go to level 2, you kind of run your drill, your fire drill as it is, and you run your drill and you prepare for what you might need to do should certain things happen. You need to calculate your long delta portfolio exposure. You need to know how much long delta you might want to hedge and what percentage you might want to hedge. You can beta weight using the SPY across your entire positions, and then look up the 30-day expected move and multiply the SPY beta by the 30-day expected move times 3 for a 3 standard deviation move. That should give you the extreme expectation of where this might go should things become significantly nasty. Consider lightening the exposure if you're not happy with the amount of exposure given in the current risk level. Consider closing out any bullish swing positions, or at least review each for tightened stops, or to manage profit management more closely. Add up all your core put selling positions, especially if they're naked. If you were to be assigned everything that you have on the table, are you really ready to accept that? Remember, at least for those that are modeled here, we said that we're willing to own those shares and the position size at that strike. Are you really willing to own all those shares? Do you have the trading capital to actually take possession of all those puts? Selling out those puts at the worst time and locking in those profits is often a very ugly plan. And it may be that if you can simply lighten them up at this point and then re-enter when the market stabilizes, might be a better thing. It's a thing that you need to review your positions and consider what would be the better decisions. Now's the time to ask those questions and ensure you have a plan. In terms of the position sizing, they're both at 50%. Technically, the intermediate term market posture turned a first day bullish reversal signal yesterday on the S&P. But given the overnight action, I expect, unless we have a really big reversal today, that this will get invalidated and turn back to bearish. And indeed might even be very bearish. So this I take as a little bit of a whipsaw action from the little bit of rise yesterday and turn that line just ever so slightly. So I'm discounting that at this point. And to me, much more important is the hedge warning status here of level 2. Now that level 2 is based on a whole bunch of different things, but you remember on the top of this sheet we had a sea of red, and we also have a lot of warnings here in the lower part. Market in decline, sharp increase warning. Futures on the VIX is up over an 18. We do have a VIX squeeze. It's right on a daily squeeze signal, and that means that if that thing fires off today, long for volatility, the market could explode down. Also, distribution day count continues to be extremely elevated, with the S&P at an 8, the NASDAQ at a 9. You have skew has been elevated all along, and we've had some 2 standard deviation moves during the time that these skew warnings have been firing. And the current week out expected move is well over 50, which is elevated as well. Then New York Stock Exchange, again, another warning, 361 on the new lows yesterday. And then all 5 intermarket risk aversion indicators are firing as risk off. The fear and greed index is down into the fear, and it continues to just ever so slowly work its way down. In terms of special opinions, the VIX is in the second day outside the acceptable window to initiate new positions if you're a novice trader. And even for more experienced traders, you might at this point want to consider reduced position size given the probabilities, especially in this next week, of increased volatility and delta moves. Cover call strategies and put selling also not acceptable to initiate new positions for novice traders. Aggressive traders might want to consider a whole host of defensive postures that may be invoked, and at the very least consider reducing your position size until you are more confident of the intermarket and intermediate market posture. So a lot of warnings here. In terms of sector specific, the market posture is getting pretty close to a sea of red here. Only consumer staples has held up thus far, but indeed everything can drop when the broad market drops. Now yesterday, of course, was that up day with the exception of utilities and materials, but if the current action of today holds up, this could be a sea of red today. Now, let me just mention one thing about hedge risk level 2 and all these warnings. We are still considered to be in a generally bullish long-term market, and often right when the warnings become at their peak and the hedge risk levels are elevated is when the bulls come in and take it the other way, and we could very well have an inter-day reversal today. We have seen big body moves repeatedly in recent days, and we could end up with a great big green bullish candle today before it's all done. So while we are talking in terms of elevated risk levels, that is not a prediction that the market will necessarily go down by a significant amount or that it will go a certain distance. But what we are saying is that there is clearly elevated risk conditions in the market, and you need to be prepared before it gets a lot uglier if that were to happen. So the probabilities of that happening are much higher. The certainty of that happening is not there. So very, very important distinctions there. But now's the time to take action and be ready for those potential outcomes. Okay, I think that's probably enough for today. If you find that what you're getting from here is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, like us on YouTube, subscribe to us on the YouTube channel. You can also send direct emails to support@falconglobaltraders.com. We welcome the commentary and feedback. In terms of special offerings, I think I'll probably mention this one today, the Cover Call Mastery course. I have finished the initial slide deck on this, and I'm looking at rolling out the specific course description and so forth probably right after Christmas, and looking to have this course start towards the end of January. So things are definitely coming along on this. If you think that you would have a potential to be interested in this course, just send me an email to Stephen@FalconGlobalTraders.com, and I'll be sure to put you on the list to get additional details as soon as I make those available. I should say that this is a very, very comprehensive course, and will ultimately result in a complete rules-based trading strategy. So this is not the little intro to covered calls that you can find, all over the place. I get that, but this instead is a very, very comprehensive course. We'll go into great depth on stock screening, fundamental analysis, technical analysis, strike selection, exit strategies, and there are many. But when you get to the end of this, I would suggest that you will be a much more competent covered call trader. If you have never traded options before, this would be an outstanding course to be able to learn about basic options. Covered calls are usually the very first thing that people do when they enter the world of options, and this course would absolutely bring you on to be able to understand how to work with options and enhance your returns and reduce your risk of those positions. So enough on that for today. Disclaimers as always, hit the pause button if you need more time to review. Also, you see the hyperlink here to the full disclosures. And we'll see you back here on Monday morning for the Falcon Global Market Preview. Good trading.